Okay, good afternoon. Sorry for the brief delay in getting going. It seems like about every time we come into class, there's something that's not working on the systems, and so we've got to bring somebody over from AV and because to sort of apologize for that. It's about 7 minutes or so we've lost, so I apologize. So what I'm going to do today is that's from where we left off last time, and we're going to talk about chapter 7. And one thing I indicated to you on Monday was the fact that chapter 7 is a pretty important chapter, and it's got a lot to do with a lot of the material and the concepts that we're going to be covering a bit later. So I'm going to cover chapter 7. I don't know if I'm going to get all the way through it, and which I don't really. To me, it's not a big deal if we get through it or don't get through it. So there's no real rush on this because a lot of these concepts are really going to be important to know. And frankly, I have to say, this may be the trickiest chapter in the text. Frankly, I think that maybe I should make you aware of that. Not that it's impossible, but just that there are a lot of relationships that are mathematically expressed and they interact with others. So it's not, they don't stand alone, that they interact with others. And that's sort of what I'm going to be getting into today, is this interaction, particularly focus on the marginals. Okay, so we're going to cover chapter 7 today. We'll probably pick up, I think what we'll probably not get to today is sort of the long run dimension of this, which takes into account costs over the very long term and how they might change and how it might explain the way businesses look over very long time periods in terms of their cost structure, and why it's difficult sometimes for new firms to enter an industry. Sometimes it costs an existing firm so little to produce a good that any new firm that comes in with no customers, no market share at all, just simply can't compete. And so just think about a company that would try to compete in something like aerospace, where a gigantic amount of costs and no customers, and you're trying to produce a very expensive product. It's just really prohibitive. And in fact, the only new entrance into that space has been state-owned enterprises, whether it's China, Russia, other countries like that. It's usually not something the private sector even is able to raise the capital to do. Maybe one day that'll change over time as the volume of air transportation picks up. If you can believe it, it probably will, but that's an example. So we'll talk about that long run dimension. That'll be probably in the next week. What I want to focus on, what I want to focus on today is more the short-term nature. And so we'll talk a bit more about what short-term versus long-term is, because I think it's an important thing for us to be focusing on, okay? And I'm going to be sort of moving the camera around because I think I hope I learned my lesson from last time. I haven't done an attend anywhere class with these sort of limited board spaces. And so I'm going to be sort of asking the classroom to sort of swivel that way to see what I'm going to be doing. So kind of bear with me on that. Next week, we'll get into chapter 8. Chapter 8 will lead us into only the third segment of the class, which is dealing with what we call market structure. And that is the idea that different industries are organized differently. So we'll talk about that. And then on a week from today, we'll review for the next exam, which is coming up next week. And so I'll spend, whatever amount of time, 40 minutes or so, 45 minutes, talking about the exam, answering any questions you've got, covering any material that you want to have covered, okay? So, questions for me about anything relating to any of that? Okay, well, let's do this. I want to sort of pick back up from where we left off last time. I'm going to sort of drop the lights here a little bit, and I'm going to go back just a little bit here. I know, and if it sounds like I'm repeating myself, there is a reason for it. And that is this idea, and I want to sort of emphasize the importance of some of these relationships as they relate to each other. And that's the idea of three kinds of values in economics. And believe me, I'm not going to spend all hour and a half or whatever talking about these three variables, but I do want to emphasize the importance of these because these will do what we call articulating. That is, they'll work with each other. Totals and averages and marginals. Marginals are what we call incrementals. This is, as I indicated last time, it's maybe the most important of the values that we're interested in economics, because it kind of goes back to this idea of why are we studying econ in the first place? It's so that we can find out what's going on, so we can make changes, we can make decisions. And so as a result, this is a value that may be able to be under control. And as a result, we can sort of move these others. And I talked about last time some of the problems with averages, and we're going to see that play out graphically as I prepare some of the graphs that sort of are designed to articulate that as move relate to one another. So we're going to be talking about marginals today, and we'll be talking about. And remember, this whole chapter is dealing with the concept of production. Okay, it's dealing with the concept of production. So we're not really talking about the demand side at all. Let's not worry about the demand side so much. Other than the fact that when I introduced marginals too, I said that in consumption we had marginal utility. That was back in chapter 6. We talked about the idea that as people consume more output, its marginal utility is what we call a diminishing function. Now remember this idea of a diminishing function, and as I said before, that I think most of us are familiar with diminishing functions, and it's almost part of everyday speech. Somebody gets diminishing returns if they do too much of something. You go to the gym 8 hours a day, you're going to really have diminishing returns set in. But also in production, we have diminishing marginal product. So what is marginal product? It's the change. Remember, any marginal is an incremental. So it's the change in something divided by the change of something. So it's the change in output divided by the change in input. Change in output divided by change in input. So it's the change in, and by the way, it's the change in the total divided by the change in the input. And this has a dollar figure. We're just like in the discussion of utility, where we talked about utils and how much benefit or satisfaction someone was getting from consuming a good. Now we're going to talk about what the cost is in dollar terms of producing goods, and that is the marginal cost, which is really a very important value that we're going to be talking about today. And it's really going to get us sort of into talking about what these costs look like over time and why the marginal drives the average. And it's going to be an important relationship that we'll talk about. And then we'll talk about marginal revenue, which is incremental revenue. Okay, marginal revenue is incremental. It's the change in revenue as we progress. Now, as I've said a number of times before, and all the way back to our discussion, week 2 or whatever it was, when we talked about the Appendix A, that we use these delta symbols for change, and rather than intimidated by them, just know that it's new minus old, new minus old. All we're doing is going from one incremental level to the next, and I'm going to sort of be illustrating how that whole thing is going to look. Okay. All right. So, any questions for me about any of that? Well, let's do this. I want to talk a bit here about marginal product and what that is. And I just want to introduce it, and then I'll get into some of the graphics on this. And if I am going too quickly at any point, just feel free to stop me. I want to make clear that I'm not in any hurry to kind of get through this, and because I would rather take the time in order to explain it so that so everyone's comfortable with what's going on. So, what is marginal product? Marginal product is a reflection of what's called the production function. Let's define what that is. The production function is simply a mathematical relationship. Well, first of all, the term function should probably tip you off, but there's something mathematical going on here. And it's the relationship between inputs and outputs. And I say value of inputs and value of outputs. Right now, let's not worry about the dollar figure of those. Let's worry about the numerical part of that. That is numbers of outputs given numbers of inputs. So if I hire 2 workers to, I don't know, make 10 pairs of shoes, and I hire 4 workers, how many pairs of shoes can they make? That incremental addition of 2 additional workers. Incremental output of units, okay? So units of input, units of output. When I say value, we're going to put the dollar figures to it, and that is going to be the idea of cost, and we'll talk about how cost interrelates to production. So marginal product is simply change in total product divided by the change of inputs. And the inputs here are labor or capital or whatever it is. I'm going to sort of simplify our discussion here by simply focusing on labor as an input. I think it's the easiest to understand. And certainly this idea of the production function, I think your text probably gets into some details that we're not really that interested in here. For those of you who will study econ any further going forward, after this class, you may decide you never want to do that, which is that's perfectly fine. You'll get into what those functions look like. They're actually algebraic expressions of relationships between inputs and outputs. And then you can put dollar figures to it. You can do all kinds of forecasting and all kinds of things. So just like marginal utility, this is a diminishing function. So in other words, it reflects what's known as the idea of what's called diminishing returns. Now in economics, we will sort of modify that term diminishing returns by saying diminishing marginal returns. But I probably should have put that little adjective there, diminishing marginal returns. diminishing marginal returns. That is, the more we employ of something, the less and less we get back of that on a marginal basis, on an incremental basis. And I'll give you a bit of an example of how that might look here. I'll give you sort of a graphical example, and sort of a numerical example, so you can see how that works. And then we'll bring cost back into the picture. So we will bring dollars into this because that's obviously the way we measure things. One thing that we should know about all known production functions is that they experiencing diminishing marginal returns. All known production functions experience diminishing marginal returns. This is sort of a, I guess, a mantra that economists sort of key off of very often. It's the idea that as we enter new inputs into the production process, we get less and less benefit from them. Just as one example, and I'll give you an example here. And let's use not labor so much, because I'll get to the labor example in a minute, but just something like telephones. So think about this: you're a firm. Let's say it's a coffee store, okay, like a FedEx, Kinko's, or whatever, and you've only got one phone line. Okay, now how productive is that, right? Because if somebody's on the phone, then obviously customers are trying to call in, can't get through, hang up, don't call back. It's not very productive. What if we had a second phone line? Now, this is an addition of an input, right? It's an input in the production process. Well, then we're going to miss fewer calls. It's going to be more, but we're going to be able to produce more because more people are going to be calling in, or whatever the business is. Doesn't have to be a coffee store. And then if we had a third line, we're going to get even more benefit because maybe some people were not able to get through on lines 1 or 2, couldn't get, and there was no third line, so they got kicked off. So we're getting more and more benefit, but if we add 10 lines, 12 lines, we're not getting that much incremental benefit. Okay, we've exhausted the opportunities for us to grab incoming calls. And so as a result, maybe we want to dial it back and go the other direction. By the way, this does happen all the time in business, where firms will dial back inputs, including labor. And sometimes people will interpret it as being, well, the economy overall is bad because so-and-so is laying people off. That might not be the case at all. It may just be a recalculation of diminishing marginal returns because of the fact that the inputs that are currently being produced. Remember, it's the incremental level. Where we are now is not productive. If we dial it back, we'll be more productive. And by the way, we save money cost. And that's always an important consideration if you're a business. Because remember, and we'll say this again, what is the objective of a business? If maximizing behavior is a characteristic of all economic actors, then what are businesses out to do? They're out to do what? Maximize. What's that? Profit. Maximize profit. And we're going to say economic profit as sort of as a principle to go forward there. Okay. So, and before we leave, I want to come back to this idea of profit, and because I want to sort of link. It was the very last thing we talked about. I think I actually went about a minute or so over last time, because I wanted to focus a bit more on this profit idea. But before we do that, let's sort of work our way up to that by going to dollar figures. And so marginal product basically has that particular characteristic. Okay, so as an example here, let's talk about what this might look like in terms of employment. And I said the examples that I'm going to give here are all going to be based upon the input of labor, because I think it's just easiest to understand, and certainly we don't want to complicate the analysis by including capital goods and labor goods. We use the K symbol, which I think is the German way of spelling capital. That must be, it's very old school, I know, so I don't know where precisely that comes from, other than to say that it is sometimes used. And so if you see that, that's what it's referring to. Okay, so let me see here. All right, so I've got an example here of what we're trying to do in terms of the production function. So what does this look like? So I've got a very simple example here of, can everybody see this? Okay, we've got quantity of labor, okay, and we've got 0 workers, 1, 2, 3, 4, 5. And by the way, I know that we should specify, and I did on this board over here, a day, a week, an hour, a shift, whatever. There's got to be some sort of time element and it's got to be apples to apples. If it's like workers per day, then it's got to be total product per day, marginal product per day, whatever. Okay. So we've got total product, which is the total amount of output, right? Expressed. And these are all, by the way, expressed as units. Total product of labor and marginal product of labor. Okay. So what is the marginal product of labor? Well, it's simply this. It's the change in total product divided by the change in the quantity of some input. In this case, it's labor. Okay. So I'll put a little subscript L there. Okay. All right, so 0 workers means 0 production. That is not too difficult to apprehend. So we hire 1 worker and now they produce four units. Whatever the units are that's being produced per day, 1 worker produces 4 units of output, and that is a good thing. We hire a 2nd worker, now we're producing 10 units. Well, that's good. That's good that we're getting more production. In fact, there's an incremental increase, and we'll talk about that in a minute. We hire a 3rd worker, now the total output of that particular unit is 13. Another worker goes to 15, another worker goes to 16. So that's considered to be sort of a good thing because we're getting more production. This is not unexpected though, is it? I think we expect that as we hire more workers to do a production process, that they're going to be more productive. Whether it's answering calls, whether it's making widgets or doing tax returns or whatever it happens to be, we would expect that productivity. But here's the thing. So if we're talking about the change in total product, then we're going from this incremental level to this. And so it's going to be essentially the change between 4 minus 0 and 1 minus 0, right? So the answer here is very simple. We'll sort of put that right there as 4. And we oftentimes put that as sort of a half step. When we talk about marginals, anything, we sort of put it as a half step in between these because we're going from one incremental level to the next. Okay. Well, in this case, the denominator is going to be the same every time. It's going to be 2 minus 1. I mean, it's going to equal the same. 3 minus 2, 4 minus 3. So it's going to equal 1 all the way across. So let's just do away with the calculations because I think we can handle the math without any problem, especially if the denominator is always going to be 1. And it's not always going to be 1, but we're taking baby steps here. And so what have we got going on here? So we had 1 worker, and now that worker is producing. And that one worker is the production unit. They're producing 4 units of output. We had a 2nd worker, so now we go from 4 to 10. And so now we've got 6 incremental units being produced. 10 in total, but 6 through the addition. Well, that's a good thing. It means we're producing more output as we employ more workers. And if you go back to the idea of, just think about this idea. We'll take our example of the Kinko's, the copy store. If you have 1 worker, okay. And think about productivity and think about the tasks that are to be done. What is that worker's job, basically? And it's 1 word, and that is what? In the entire place, what's that 1 worker's job? Starts with E, ends with a thing. Everything, right? Everything. Everything, right? Everything, they have to do everything. They have to answer the phone, they have to wait on customers, they have to go to the post office, they have to open the mail. They have to do everything, they have to sweep the floors, all that. So that's not very productive. You had a 2nd worker and you have a division of labor going on. So now 1 worker can sweep the floors and go to the post office to do that. And the other worker can focus on doing whatever it is he or she is doing. And as a result, we had a 3rd worker and we divide the tasks even more. But there is a limit to how many workers we have. And this is the thing that I think most supervisors, I don't know if anybody here has ever supervised anybody, but most supervisors and I'm talking about supervisory level of management. I'm not talking about top management. I'm talking about people who manage directly other people. We'll notice that as you hire more people and bring them together in a work unit, what do you see happen? Productivity tends to decline over time. And that's because of the fact why. This division of labor, these early gains that you got by adding workers goes away very quickly. And now you have the division of labor now becomes muddied. It becomes overlapping. And so now you have 2 people who go to the post office together for whatever reason, when it only takes 1. You also get this phenomenon of people talking with each other and visiting. It does happen, right? And I know that it drives supervisors crazy when people spend too much personal time. And I know that workers push back on saying, oh God, give me a break, and whatever. I mean, and I know most employers are pretty lenient about people taking bathroom breaks or smoke breaks or whatever, but all that does take away from production, even though it's sort of necessary. But what is notices the fact that the more people you've got going on, the less that it gets done incrementally. So as a result, firms will sometimes dial it back, and they'll do it for that reason. And look, this does happen, and it isn't just in a production environment. I know that one of the things that I think we should be clear about, and it's every econ textbook that I've ever seen, particularly at the introductory level, will focus on manufacturing businesses as being the example of production and output and input versus output decisions. But it's also at a service level too, whatever that service is. even if you're not producing a physical output, whether it's a call center answering calls, whether it's a customer service area of like a Walmart, addressing customers, the more people you've got involved, the more overlap there is. These division of labor responsibilities become intersected, and it takes two people to do the same thing. And by the way, this does happen. I mean, I've worked in office environments in which we come in on Monday morning, and of course, Monday morning is always problematic. Everyone's kind of dragging in from the weekend. And then we spend until 11 o'clock talking about the football games the day before. And then it's 11 o'clock. Why don't we just go to lunch? We'll pick it up when we get back. Right. So we'll go to lunch, we'll get back at 12:30. So we've lost a half a day because we were yakking about football. So you have a question?
Do you think that's like one of the factors why all these layoffs are happening?
It's one example, I think, for sure. I mean, the layoffs are starting to happen. And I think I think probably they're looking at this equation and saying we've got too many workers for what is expected to be the volume of output. I think that most people are looking at I think we're on the verge of a recession, probably. We talk a lot more in macro about that than we do in micro, but I think the indications are good because if you look what's happening in the macro economy, the government is trying to slow things down, and they're not really succeeding at doing it, are they? I mean, because inflation and unemployment, which I know are not really micro topics, but it's a good question as to the layoff question. It's sort of a whack-a-mole game. The economy heating up, and so they hit the inflation mole, and then up pops the unemployment mole. So they're trying to bring inflation down, which will raise unemployment. But a lot of employers are expecting that to happen. They're taking proactive steps to lay workers off because they expect the volume of output to probably go down. That's one of the characteristics of downturns in the economy. And so if you, as a result of this, you don't want to have workers out to here when your output is up to here. So that's a good question as to that. And when I say the government's doing sort of they're trying, I mean, they really are trying to bring the economy down to what is sort of this unicorn, this mythical thing called a soft landing. And it's only happened twice, where the Federal Reserve, which is our central bank, is trying to slow things down to try to bring the economy down to a soft landing without causing lots of unemployment. But it's only happened a couple of times. One was during the Vietnam War. And so as the government was trying to slow things down, you got the Congress and the president pushing forward with spending on Vietnam, the space program and all that. So that sort of mitigated that. And then in '94, they tried to slow the economy down and then sort of backed off. And I remember those days I was in the financial world. The financial world just went bananas and sort of shouted down the Federal Reserve. So I think we're probably looking at a recession. So to answer your question, yes, I expect that firms will go this direction with labor a lot of times. And by the way, this is not unexpected because I've been telling classes now for at least a year that if you look around, just see the help wanted signs, which are beginning to disappear, frankly. I mean, up until just a few weeks ago, you could walk into a Subway. The Subway on Gibson would have a sign on the front door saying, starting wage $15 per hour. I don't know if it's full-time, I don't know if there are benefits or retirement, I don't know, but $15 an hour is a pretty good starting wage, considering what kind of skills do you have to work at Subway. I don't know, but I'm guessing it's not, you don't have to have a PhD in whatever it is, sandwichology, right? To do that. That's a pretty good wage. I would take $15 an hour if I were looking for a job. And but that's a sign of the fact the economy is overheated. It really is. You know, that's for an entry-level job, that's a pretty good wage. Now, I know it's not the same as a living wage. That's a whole other discussion, and we'll get into if you take macro, we talk more about that. But that's an example of that. So yes, I think we're going in that direction. So back to this issue here, there is a point at which we can add workers. So let's do this. So we've gone from 0 to 1 worker. Okay, that's good. We get a little pop to marginal product. That's good. But we add now a second worker. Now we go from 10 to 30. We had a second worker, we go from 4 to 10. Now we had a third worker. Now we go from 10 to 13. So now, oops, what's happening? Marginal product is falling as we go from one incremental level to the next. And that is really what's going on here. This is why this is a diminishing function. Any kind of a diminishing function is the idea that on the margin, and we use this term on the margin to mean what? From one incremental level to the next. It's a diminishing function. So, and most of these marginal relationships that we get into in economics are considered to be diminishing functions. Okay. And I think that's an important thing to know is the idea we get incrementally less bang for the buck. And it does happen when you've just simply got too many workers doing what they're doing. And by the way, and I want to make your question about this macro issue is an important one because I think sometimes people confuse layoffs with macro phenomena. And sometimes it's a good sort of logical leap, and sometimes it's not. I remember, you could take a firm like Intel, which employs lots of workers. Maybe the economy is booming, but maybe the local Intel plant wants to lay workers off because of the fact that maybe they want to shift workers doing whatever they're doing there to doing something else somewhere else. And so they want to go this direction. It is not unheard of for firms to go up this way, that is to lay workers off. And of course, business firms have their own sort of, I don't know, lingo, they call it right sizing or whatever. Workers have their own terms for it. They'll call it reduction in force or simply being laid off or canned or whatever. And sometimes firms will simply redeploy people from one area to another area if they find that area is no longer as productive, particularly if it is an area where the business firm is declining. And this is something that in the business school we talk a lot about, but we should probably talk more about. I know that a lot of business professors believe that we don't talk enough in business about how to manage a declining enterprise. There are cases in which businesses are declining. They're no longer going to be as productive over time because whatever good they're producing is no longer in demand, but you don't want to stop making it because you're still making money doing it. So why not keep doing it, right? If people decided that sugar was bad for you, and I think there's probably some evidence that it is, and so people are switching over to a sweetener, that doesn't mean that sugar manufacturers are going to stop making it, even though demand goes down. Yeah, maybe one day it hits the vertical axis and goes to zero, but it hasn't happened yet. So why not just keep producing it and keep producing a good until it no longer has demand? And we'll get into that just a little bit, particularly as we talk about market structure and how industries are organized. That there are some industries that have a sort of a built-in bit of protection because nobody wants to get into them because it's a declining business. And how do you attract investors to a business that 10 years is probably going to be out of business? But yet for 10 years, that's sort of a career, that's sort of a lifetime of a lot of assets you might employ. So all the furniture and computers and other technology is going to be used up by that time anyway. So why not do that? So I'm having trouble getting my camera to open up here. There we go. My camera swivel here. So, all right. So questions about that? Let's talk about graphically what this looks like. And okay, we'll talk about graphically what this looks like. So what do we got going on here? Remember, I talked about the idea that there's an interplay between the marginal and the total. And that is the marginal is simply the change in any kind of a total divided by the change in something else. Okay, so if we were to plot total product on one that's straight, is it? We're going to plot total product on one axis, put that on vertical axis there. And again, total product is expressed in units, right? And we got plenty of labor over here. Then what is the interplay between that and the marginal product? We've got plenty of labor here. And now we're going to plot marginal product. Marginal product is defined as the change in the vertical over there, the change in total product. Divided by the change in some input, and the input here again is going to be assumed to be labor and labor only. Okay. Then what goes on here? Well, look what happens with total product. You get, so if you have 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5, whatever, then you get an increase and it goes up and up and up to tail off. In fact, the slope may become 0 because if you employ a sixth worker, what is the, I mean, if you just look back in your notes here, if you're probably going to be getting to something like 0. In other words, it's going to flatten out, right? You're not going to get any incremental benefit. So maybe you shouldn't have hired the sixth worker or the seventh or the eighth. In fact, maybe you want to go the other direction and bring it down the other way. This is why firms are sometimes motivated to reduce labor. It's not a great thing. But if you go back to the 1, 2, 3, 4, 5, and I'm trying to keep this as simple as possible. What do you got going on here? You get an incremental increase as you add, and then you get a decrease. So the marginal product function, this is how we graphically illustrate that it's a diminishing function. It is a diminishing function over time. And so you get this early stage increase in productivity due to why? Well, let's talk about why we get that. Why do we get this little fish hook kind of thing going on here? It's because of the fact that as we add more units of anything, in this case, it's labor, we get more productivity because we get more division of labor. We get people, we don't have one person doing everything. We get people who are able to specialize. And by the way, specialization is really the heart of what the labor force has moved to as a result of industrialization. And that is that workers are very specialized in what they do. And because they do it, they can do it more productively than doing something else. I don't run security around here. I don't, try to protect the parking lots and whatnot. I also don't teach biology. I don't think that would be very productive for me to do. Likewise, the biologists don't come over and try to teach econ. As a result, I feel like I can teach this a little bit more effectively than if I could teach everything at all. I mean, every single subject, which is, there's nobody anywhere able to really do that. So we get the early stage benefit. We also get people specializing. But then as we add workers, we slide down this direction and we get this idea of the diminishing function. And that's really the key issue, is that we're operating somewhere probably here. So really the relevant range, what we call the relevant range of decision making, is somewhere in that downward sloping sort of area. Okay? It's in that downward sloping area. And I think that's an important thing for us to be familiar with. Okay. Okay, well, I want to go up. So are there other questions about that? What that look like? Okay, well, I want to talk about this idea of, let's bring dollars back into it. So if you go back to the previous slide in the slide package, I know I'm sort of toggling back and forth, but I do want to sort of get to one. Oops. Let me see. Where's my care? There it is. So if we talk about marginal cost, what is the marginal cost? So marginal product and marginal cost are related to one another, and they're very much intricately tied into one another. So it's important that we understand what is marginal product. It's the change in total product divided by the change of an input. We got that. And then if we bring dollars into it, this total product now flips down here, and now it's the dollar figure that we're trying to get at. Again, I want to reiterate something I've said before, and I'll go on saying it, is this is a dollar figure. Obviously, cost is always expressed in dollars. This is a unit, and again, whenever in economics you have a dollar figure, either multiplied or divided by a number, whatever the answer is, it's going to be denominated in terms of dollars, right? So if you work 5 hours, you earn $10 per hour, you earn $50. You don't say that you've earned 50. You don't say that you've earned 10 hours. You say I earned $50, and you don't express it in any other terms. You don't say I earned 2 cartons of cigarettes. You say I earned $50, right? So it's expressed in dollar terms. Obviously, that's I don't mean to say, but I think it's important that we sort of keep that in mind. Okay. So back to our example here. What about this idea here of these marginals, and what can we say about them? So if there's an interplay between them, oops, whoa, hold on a second here. I put my finger on this for too long, it sort of zooms way out. So I'm just trying to adjust the zoom on this. I know that you guys in the room don't know what I'm talking about. You can't see it, but I'm just trying to adjust the zoom here. So okay. Zoom, zoom, zoom. And this thing has got a real long delay. So I hit a button, it takes about 5 seconds for me to know what's going on. So this is live television. Okay. Okay. All right. So what about this issue of cost as it interplays with marginal product? Well, let's think about this, and let's just take this marginal product function. I'll leave that there, and let's just now. I guess I could have left total product up. That's fine. But let's bring in cost here into the picture. And so now we've got marginal cost on this axis here. In fact, rather than put marginal cost in, what we're probably going to do from here on out, and it's something that I alluded to back when we first started talking about the appendix A and how we in economics label things. We tend to put things of a dollar figure or a percentage on the vertical axis, things of a numerical nature on the horizontal axis. I'm just going to put dollars here, okay? Because we're going to be overlaying marginal cost with other kind of costs like average cost and average fixed cost and revenue, and so all that. We're just going to say this is the dollar axis and this is the quantity axis here. So quantity of labor is a quantity axis. Again, that goes back to what we're talking about. So think about this, okay? So we've got this issue going on where we've got an increase in productivity. Well, increase in productivity then must translate to what? It must mean that there's a declining cost. So there must be a relationship going on there. That is, as we're producing more output, we're getting more bang for the buck, if you like. It's actually cost effective. And so as a result, from this area here, we get this sort of thing going on. There's this sort of relationship here. And then as diminishing marginal product sits in, that is, we're employing labor that becomes less and less productive. And so as a result, marginal cost goes up like that. And so one thing looks like the other. It's almost like you took this and flipped it through the screen, and one is a mirror image of the other in this respect. Marginal cost simply is the dollar reflection of the productivity of whatever the input is. In this case, it's labor, but it could be any production function. Any production function simply involves the relationship between inputs and outputs, which is what's being expressed here. Now we're bringing the dollars into the picture. And before we leave, one of the last things I do want to get into is what kind of costs we're capturing in this. Because at this point, all we're really saying is, what is marginal cost measuring? Marginal cost is simply this: it's the change in total cost divided by the change in total product. So you get a dollar figure divided by a number, and so you're going to end up with some kind of dollar figure. Okay, whatever that dollar figure is going to be the answer there. Okay, and then total product is simply the change in what. This is the equation for that there. So they are related to one another, and it's an important relationship. And one is sort of mirroring the other in terms of how they fit in. Okay. All right. So questions about that and what that's all about. Marginal cost is an important figure. It's an important value. In fact, we're going to be coming back again and again. The reason I say that chapter 7 is so important is because we will, in fact, be coming back again and again to marginal cost. And we'll put it together with the other side of the equation, marginal revenue, but we're not quite ready to do that yet. We will do that, though, as we bring in the demand side of the equation, which we have not yet done, but we certainly will, beginning in chapter 8, and then for the next few class sessions after that, as we sort of build our understanding of business firms and talk about how that. All right, so questions about that. All right, well, let me do this. Before we get in, I've sort of taken the numbers that I've built on that very simple spreadsheet. I think it's very simple. And I sort of recreated them on this board over here just because I need the room to sort of work with, okay? But I want to talk about some additional definitions that I don't have on slides here, because I just want to make sure that we are getting all this together. So we've got marginal cost here, but I want to talk about some other costs as well, okay? And I'm going to go and erase this. Hopefully everyone here has got that. If you don't, you can see me later. Actually, you can reproduce it. But I want to do this. I want to create a new graph that takes into account the nature of cost in general, okay? So let's rewind back to Monday, because we talked about this very basic relationship everywhere in economics. That's the idea that inputs are sort of corralled together. This is what the activity of the firm is. They're brought together and be one roof, or even today, that's not even a very good metaphor because people are distributed everywhere, but you're bringing them together in some sort of organizational construct in order to make output. And those inputs are labor, they're materials, they're capital goods like machinery and equipment. To produce, to run through the hopper and create some valuable output. That you can do what? Sell to a buyer that will pay you the value for it. That exchange value is the price of that good. But again, there's a difference between price and cost. There's a difference between price and cost. Cost is the value of an input, price is the value of an output. Okay, so I think that's an important thing for us to talk about. But let's talk about the nature of cost, because not all inputs are the same, right? So if we put dollars on this axis here, and we put units on this axis, which we can think of as total product if we like, right? Or Q, right? And I go back to this thing that I talked about on Monday. If you prefer to look at it as Q, which it's quantity, it's not quite the same thing, but it's close enough that we're not really going to be worried that much about it, right? So what kind of cost have we got going on here within a business firm? Okay. So remember, we've got fixed cost and we've got variable costs. And let's define what a fixed cost is. A fixed cost is simply a cost that does not change with the level of output. Okay. So let's talk about that. If fixed inputs create fixed costs, then fixed costs are those costs which do not change, which do not vary, right? Which do not vary. And I am with output. And output will simply define it as total product. But I'm going to add one more what's the word I want? Modifier to what I talked about on Monday, and that is in the short run. in the short run. And okay, well, what is the short run? And if there's a short run, then what is the long run? Well, for right now, let's just focus on the fact that the short run is sometime that's shorter than the long run. Okay, I know it sounds like an economist's answer, almost a weaselly politician's answer, but it's something different. In fact, I mean, if you really want the definition, it's the time it takes to vary all of the inputs, right? So costs which do not vary with output in the short run. Okay, well, then what are variable costs then? Variable costs are simply this. Variable costs are those costs which do vary with output. Okay, which do vary with output. And in the short and long run, both the short run and the long run. And the reason that they vary in both the short run and the long run is because of the fact that by definition, we're going to say that all costs in the long run are variable, but we'll get to that issue here a bit later. Okay. All right, let's talk about what costs might look like from the standpoint of a business firm. And let's say that you're, I don't know, let's say you're producing pairs of shoes, right? So you've got incremental levels of production. So and let's say that we get to a level of production where it's 10,000 shoes a month. Okay. As a result, 10,000 shoes a month, you're going to have fixed costs that aren't going to vary, and they're going to be equivalent to $50,000. There are dollars on that axis, right? Okay. In other words, this is the fixed cost function. It's simply a horizontal line across the screen. Nothing too difficult really to understand that, right? But here's the thing: as we get to an incremental level where we now have to add inputs, because why? All right, we've got 10,000 units of production, but we're at capacity. We have no more room to put equipment. We have no room to store the inventory that we are making before we sell it. We've got no room for trucks to pull up. We are at capacity. So we need to do what? We need to add capacity. So we need to jump up to the next level, whatever that level is. And by the way, we're talking about these levels. What we're saying here is that with fixed costs, that fixed costs of the dollar figure, the fixed costs involve what are known as lumpy inputs. And it sounds like I'm just making this goofy term up. Lumpy inputs. And that is this: you can't go from one plant to 1.25 plants. You've got to go to the next level. Let's say that if it's a Wendy's, right, and you're now at capacity, you've got, you're serving all the customers you can. You have no more room for people to sit. The drive-through is jammed. You want to add another Wendy's. Well, you can't build a fraction of a Wendy's. You've got to build a whole new Wendy's. And so as a result, you step up to the next level. And so as a result, you go from what this now becomes identified as FC1 to some FC2. And so as a result, it's lumpy. And then if you get to the next level, whatever that is, 20,000 units of output, then you're going to jump to a next level. So we have what's known as a step function. And that is the idea that these costs are lumpy. And so if we talk about costs which do not vary in the long run, let's be very specific. Or in the short run, I'm sorry, do not vary in the short run. Let's be very specific as to what kind of costs we're talking about here, right? Right now, I just want to focus on fixed costs only. I think that's the important thing. If they're lumpy inputs, then what are we really talking about? So fixed inputs, right? So fixed inputs create fixed costs. So what are these fixed inputs and what are some examples, right? Well, let's focus on the labor piece. This is important that we focus on the labor piece because I think it's the easiest for us to understand. An example that I gave over here, and this was just output, it did not involve costs. We're saying that we're hiring 1, 2, 3, 4, 5, or 0 units of labor, and maybe they've got a fixed wage, but probably not. They've got a variable wage, meaning that they may have a fixed amount per hour, but their hours different. And that's why workers who have to report their wages, we call them non-exempt, because they're not exempt from reporting hours, have to report their hours. So that they're paid a fair wage. They're not paid some fixed amount, beyond which it lowers their hourly wage. And so they're required to report those. But there are some workers that are considered exempt. That is, they don't have to account for their hours. And what kind of workers are we talking about? Primarily. What kind of hour? And they typically earn a salary. So what kind of workers are we talking about? We're talking about managers and professional staff, right? And by the way, our Department of Labor has got very distinct definitions of what classifications of labor can be paid a salary as opposed to, in which case they don't report their hours. Okay, they can work 30 hours a week or 80 hours a week, and they'll still get paid the fixed wage. And let's not worry about things like bonuses and all that. That's a whole separate issue. That's really not related to production anyway. It's related to overall profitability. That's complicated. Right now, let's just focus on salaries. It's fixed, right? As opposed to an hourly wage. An hourly wage will vary, right? Not the wage itself, but the hours will vary. And so as a result, workers who work 40 hours a week will get paid for 40 hours. If they work 30 hours a week and they're considered non-exempt, that is non-salary, then they'll work 30 hours and they'll get paid 30 hours times whatever their hourly wage is. But salaried workers, because they are in a special classification, managers who cannot be expected to work only 40 hours a week. In fact, most managers work more than 40 hours a week. That's my experience, at least. Are there managers out there who work 20 hours? Yeah, maybe. And sometimes you see articles in, I don't know, websites where this person only works 10 hours a week and they make 1.5 million or whatever. It's like, well, let me have that job. What is it they're doing that we can all do? It's rare. It doesn't really happen. Most managers are working greater than 40 hours a week. And sometimes they're working 70, 80. I think at one point I was up to 90 hours a week, which I don't recommend. And you can't do it for that long a period. But you might have to do it. And then conversely, maybe you work 30 hours the next week or whatever. Or maybe you take a day off or take a week off, and it's not that big of a deal. Whereas if you're an hourly worker, it has to all be accounted for. So salaries are distinct from hourly wages. It's an important distinction because salaries are a fixed cost, okay? And are considered a fixed cost. So if you're going from one incremental level to the next, and let's not do that. Let's do the Wendy's example. I think it's a better example. So 10,000 customers a day, you're at the capacity, right? So you need to add a new store and a new manager, right? You just can't add a fraction of a manager. You can't add 1/15 of a manager. You've got to have one manager or two managers or three. It's got to be a discrete value, and it's lumpy. You don't have a fractional way to do this. You can with variable inputs because you can do fractions of an hour. Somebody can work 7.35 hours, 7.5 hours or whatever. You can fractionalize that. You can't really fractionalize that. So they're lumpy. They go up, they have a step function. Okay. So salaries would be one example. What are some other examples? Remember, we're talking about fixed inputs, which are going to be there for the short run. And the short run is simply defined as the time that the time it takes for us to be unable to vary our inputs. Okay. So salaries are one. Also, things like lease expense, right? Lease expense, and I know we're sort of on the verge of an accounting discussion here, but I think it's important that we talk about these because these are costs that don't vary. If I'm leasing some premises and I want to shut down for a month to do some cleaning, right? Sometimes business firms that deal with really gross inputs will shut down for a good month and they'll just clean the place. You may get it, they'll come out with tires and they'll clean it up. Well, you're still going to pay lease expense because your landlord doesn't care what you're doing. I mean, within reason, as long as they get paid, right? So if you're leasing the premises as opposed to owning it, that's a fixed expense. And it doesn't matter if you're producing, 10,000, 20,000, whatever, you're still going to pay that. It goes on and on. So lease expense would be one. And it's not just premises. A lot of firms will lease things like inputs like equipment, vehicles, things like computers. I know when I was in the banking world, we had rolled out an entire leasing unit so that business firms didn't have to buy stuff like phone systems and things you wouldn't think of. We had a customer that leased gas pumps in a gas station. He didn't want to own the gas pumps. He wanted to lease the gas pumps. At the end of the term, he said, "You take the pumps away or I'll buy them from you," whatever. Doesn't matter. And there are tax reasons for that, but it's fixed. He's got to pay whether or not he goes on vacation or whatever. It's still a fixed expense. And so machinery, equipment, all these kinds of things are examples of this. And also things like insurance, right? Insurance costs don't go away. So even if you shut down or you're producing 10,000 or 2,000, right? It doesn't make any difference. Insurance costs are usually not variable. They're usually more or less fixed. There's just really no good way to price insurance. There may be for some other elements you can tie to product cost. Those are what we call ABCs, activity-based costs. We'll get into those variable costs in a minute, but insurance costs would be one thing. Also things that we're getting off into a little bit of accounting world here. Interest expense doesn't your lenders that are lending you money want to be paid interest. That money's going to roll in whether they're producing 2,000 or 10,000 units or 20,000 or whatever. So those are all examples of fixed inputs, and they're sort of lumpy. Okay. All right. So questions about that. All right. So what about this then? Well, we've said here that fixed costs do not vary, but yet we've gone from 50,000 at FC1 to FC2 to FC3, and so now we've got what? We've got 75,000. We've got 125,000. Well, one thing that we can see happening here, excuse me, is that these costs are changing, right? Well, that doesn't sound very fixed to me, right? So if they're changing, then what can we say about fixed inputs creating fixed cost? And that is that this one thing you want to make sure you know this, and that is all costs are variable in the long run. Okay? All costs are variable in the long run. Okay, so all costs are variable in the long run. And what is that long run period? Because when I first gave you this definition of short run versus long run, I was sort of vague as to what the short run versus long run is. But let's be a little bit more specific as to what the short run is versus what the long run is. And I'll sort of use the example here. And if I can bring my camera up, I'll swivel this here. Oh, there's like a 5-second delay here. I never know whether or not I've got this thing being brought up or not. So, oh, come on. Well, okay, there we go. Okay, all right. So let's just give an example here. Short run versus long run. And I'll leave this up here. And the good thing about the video, if you're watching it as a video, is that you can always go back and say, hey, what was that? And you can pause it and do whatever you want to do with it, whatever, right? So let's say that you've got a firm and you're employing, you've got inputs, right? And let's say that the inputs, you've got labor inputs, right? And then you've got capital goods inputs, which we're going to call Q sub K, okay? So let's say that you've got 0 workers. Let's say we had 1 worker, 2 workers, 3 workers, 4 workers, okay? And yet you've only, let's say it's a car wash, okay? That's a pretty good example here. Say we've got a car wash and we've got 1, 2, 3, 4 workers, but we've got 1 production line, okay? So it's 1 line that brings people through, sprays the car, sprays the soap, sprays the wax and all that. And you've got 1 production line, okay? So all this is, and you've got 1 production line all the way across here. 1, 1, 1, 1, 1. But as the volume of output increases, whatever is going on, then you've got to step to the next level. And so maybe your workers are going up and up and up, but those are variable. Instead, now you're going to 2 units of this. And so what's going on is this, that this is the short run here, and this is the long run here, okay? So that's what's really going on. It's the long run is the, and what is the definition of the long run? It's the time it takes. The long run is defined as the time it takes to alter all inputs. However, that long, and it's ill-defined. I mean, I know sometimes, and this is where, I have accounting students who will say, well, in accounting, we've got a very distinct definition. Anything a year or less is short run, and anything over a year is considered long run. That's pretty useful for an accounting definition, but again, there are numerous places in which we diverge from our accounting cousins, and this is one of them. We don't know what the time frame is. It could be years. It could be years and years and years before you decide you need a second production line to handle more cars because the volume of cars is increasing. You're adding workers, but you could add workers and lay workers off. That's somewhat easy to do. I know it sounds like I'm being very flippant about laying workers off and whatnot, but I'm just simply saying it's not as complicated as shutting down production lines. It's just not. Like it or not, that's the way it is. So the time it takes to adjust all all inputs, okay? And it's usually a fixed input that's what's going on here. Time it takes to adjust or alter or make variable, whatever you want to say here, the time it takes to adjust all inputs, because in the long run, all costs are variable. All costs are variable in the long run, okay? So that's the thing I think we want to know about that is in the long run, all costs are variable. And I think we're going to get into the discussion. We got a little bit of a late start, so I don't think we're going to get into a discussion about types of variable costs, other than to simply say that they exist and that we can account for them. So what I want to do is I want to sort of take. First of all, does anybody have any questions about that little spreadsheet, that little graphic that I drew up over there? So otherwise, what I'm going to do is I'm going to sort of swivel the thing here to the new board, and it's over here, and I got to make sure my camera angle is right. So for those of you in the room, we're going to have to swivel, and I apologize, but let me see here. Are we picking this up? Zoom in a little bit here. Let's see what we got. Okay. You know what? I think the camera. Oh, you know what? The camera is sort of running into that little projector thing there. Oh, I didn't see that. I didn't see that coming. Okay. Oh, geez. All right. Well, I don't think anybody saw that. I didn't see that coming. As I swivel it this way, starts to run into that. So I hope everybody can see this. If not, and you're looking at this later as a video or whatever, and you say, "Hey, what the heck? I can't see this." So then, let me know, and I'll simply put on a spreadsheet. I'll put on an Excel sheet or whatever, and I'll send it to you. Okay. So everybody here in the room can see, obviously, but I apologize for those watching live and those watching the video. I think you can probably see it. This is live TV, folks. This is what it is. So we have to kind of deal with it. So what I've done is I've taken that very original little spreadsheet that I gave there of quantity of labor 1, 2, 3, 4, 5, well, starting 0 actually 0, 1, 2, 3, 4, 5. I've got total product, the same dollar figures. I've simply just moved those dollar figures into this. And all I'm doing is I'm expanding the spreadsheet, and I'm going to probably on Monday when we come back, I'll do some more things with it, like include average variable costs, average total costs, all those things which we haven't done yet. We will. Okay, we'll get to that. So this is not new for those of you. We're looking at the original sort of table form. I say spreadsheet. I'm used to working with spreadsheets. So it's a table, whichever you prefer. Schedule of total quantity of inputs and schedule of output. So the assumption is that fixed costs are $25. And a variable cost, in this case, the only variable cost is labor, okay? So it's the only variable cost. So total product here is labor. And again, it's a simplification, but it's the only cost we've got. So in terms of that, which varies with the level of output. So it will vary with level because we know that level of output is changing. Okay, what about fixed costs? Say in the short run, it's fixed. So and everywhere, even at 0 units of output, you've still got to pay fixed costs. Salaries, lease expense, all those things which I detailed over there, all those things have still got to be paid, whether your output is 0 or not. Salary they do have to pay. Now, in the long run, you can not pay them by you can sell a building, or you can drop some insurance on some machine you no longer have, and so the lease expense and insurance goes away. But we're saying in the short run that it's going to be fixed. That's what the nature of fixed costs are. Is they don't vary the level of output. They will change if we went further onto the scales. So fixed costs are going to be the same all the way through. Well, okay. If total cost, and we just simply go back to one thing we talked about before, if total costs are fixed costs plus variable costs, actually probably put it here, I'm not simple to see. And all we're doing is we're simply adding up column 3 and column 4 all the way along the line. So column 3 plus column 4 here is 25. 50, 75. The math here is incredibly easy, but I didn't want to, I figured you're crazy with that, but why do that? So, okay. So 150 is the example of got this. So that's what total costs do. Total costs go up over time. Okay. As we produce more output, our total costs go up. This is not some revelation. I think we sort of know that our total costs are going to go up over time. There's no doubt about that. My number's right here. So total costs are going to go up over time, and that's simply the nature of the beast. So then what is the last thing we want to compute here? And that's we want to compute the marginal, right? We want to compute the marginal changes as we go from one incremental level to the next. And remember what marginal cost is. Marginal cost is the change in total cost, the change in total product. And so we're going to have incremental level, we're going to have the change in total cost. In other words, the change in column 1, 2, 3, 5. Divided by the change in total product. Okay, so let's do that, and we'll talk about what this is and how we measure it, and then we'll see why it looks the way it looks graphically. Okay, so let's just kind of do the math here, and I don't think it's terribly complicated. Change in total cost is simply, let's go from total product at 4 units minus 0 units, and so that's the denominator there, and change in total cost is 50 minus 25. So what you end up with is that you have 25 over 4, which equals 6.25. Okay, and I'm just sort of breaking up the math so you can follow along what is with where the math comes from. Okay, change in total cost as we go from one incremental level to the next. I usually put it in sort of the half step because the costs are being incurred as we go from one incremental level to the next. In this case, the only input is labor, but as we go from 0 to 1 workers, from 1 to 2 workers, from 2 to 3 workers, etc. And the math is relatively easy all the way down the line here at 75 minus 50 divided by what? 10 minus 4. Okay, so it's going to get a little bit trickier, but not too tricky. 25 over 4, which is 6. Wait a minute. No, wait a minute. No, it's not 10 minus 6, it's 10 minus 4, isn't it? So right? 10 minus 4, which is 6. You know the same thing I did. Wait a minute, let me see here. I don't have my glasses, and I guess I can see what I'm doing here. That would be helpful with it. All right. So here's what we've got. So we've got change in total cost, which is 75 minus 50, and we've got total product, which is 10 minus 4. So it's 25 over 6, which is 4.7. This is not right. This is 4. That's why it's 6.2. There we go. When in doubt, you wear your glasses, right? So, all right, that's what's going on. So, if you get older, you get these freaking glasses. Unfortunately, that's the nature of the beast. Let's go from the next incremental level to the next. Where we've got now 100 minus 75, change in total costs divided by 13 minus 10. And that's the change in total product as we go from 2 to 3 workers. So we end up with what here? We end up with 25 over 3, which is now 8.33. So see what's happening. Marginal cost goes down, and it kind of goes up. We go to the next incremental. We go 3 to 4 workers. Now we get change in total cost is 125 minus 100. Change in total output is 15 minus 13. So you get 25 minus over 2, which is 12.5. And then the last relationship is 150 minus 125. The numerator is the same in every case. So that's good. Minus 16 over 15, which is 1. That simply reduces. And so you simply have 25 or 25 over 1 if you so it's 25. Okay. I did not intend the math to be this complicated. I just couldn't read my handwriting, so that was on me. It was my guy. Numbers because I couldn't see what I was doing. So notice what's going on here. You've got total marginal cost would sort of go down, and it sort of goes up. And so this is why we have this sort of fish hook configuration, and it's really a function of early stage implementation of inputs and the value of division of labor and the value of any kind of input that we have. Our example here is only capital goods, but it could be any input at all, because all these inputs are going to diminish their total output over time. Because one of the things about the production function, which I didn't actually get into the dollar figures of what a production function looks like. It's really beyond what we do in a 200 level class, 300 level classes we do it. But it's this interplay of inputs and outputs, and that's really what's going on. And with marginal cost, all we're doing is we're simply putting a dollar figure. So we're saying as we go from 0 to 1 unit labor, we have marginal cost of 6 1/4, 470, 833, 1250 goes at dollars on it, and that's what marginal cost is. Marginal cost goes up over time as marginal product goes down. Okay, and I didn't include the marginal product column, but it's easy just to go back to what we looked at before. When marginal product goes down, as marginal product goes down, marginal cost goes up. This is why we say they're sort of the inverse mirrors of one another, where we can take the marginal product function and sort of flip it through the screen and we end up with marginal cost. This is how they're related in that particular way. Okay. All right. So questions about this. I said at the outset, this is maybe the most challenging chapter. And I don't think the math is all that really tricky. But you've got to know what you're doing in order for it to make any kind of sense at all. And if you don't, and unfortunately you get in a position where you're sort of lost, then it becomes challenging. So my objective here always is to go as slow as we possibly need to, so we all are following along what's going on. What I'm doing is I'm sort of rotating the camera very slowly back to me here. So, okay. So, other questions for me about anything we talked about this discussion? Well, what we're going to do, we come Mondays. We're gonna do some other elements of cost. Oh, I said I was going to get into this idea of explicit cost of margin. I do want to do that before we leave. We got a couple minutes here. I do want to do that really quickly here. Actually, you know what? Let me. I'm almost out of time. Let me do that on Monday when we come back. So what I want to do is, and it's probably better to wait. It's probably better to wait. So I want to on Monday focus on some other areas of cost, including something we haven't gotten into here is average costs. Now I said averages are problematic, and we're going to talk about why they're problematic, but we're also going to talk about why we need to measure them, because over very long time periods, what is, if you ever ask the question, what is the cost of something? What did it cost to produce this can of Pepsi, right? That's what those variable measures answer. And then we'll get into this idea of profitability over the long run and cost over the long run. And then I'll circle back to this where we really started, which was profit. And I think it's probably best that we do. I think I kind of got ahead of myself as to when I wanted to cover that. But we'll cover that bit in class. And then what we don't get done on Monday, we'll finish up on Wednesday. And we may even get into chapter 8. If we don't get into chapter 8, it's no big sin, because it won't be, whatever I don't get to on Wednesday will not be on the exam for next week. So let's make it a point not to include that. Okay. So, all right. Questions for me about anything? All right. I'm available all weekend. If you do have questions, feel free to get with me. Otherwise, have a good weekend. See you next time.